Hello, everyone, and welcome back to the J22 Report. I am your host, Johnnie Market, and I just wanted to go over do a quick video on this past Friday's jobs numbers report and economic. And for those of you who haven't seen it yet, which probably most of you have, or probably all of you, as you can see, the job numbers report came very positive. They say the unemployment rate is the lowest since 1969 or 61, which you can tell these numbers are manufactured. The economy hasn't been the strongest since the 61 or 69. 1980s and 90s was much stronger than the economy now. Even 2019, the economy then was much stronger. So anyway, but this is based on fundamental analysis and what I've been preaching. If you look at Friday's market action, jobs reports came out strong. Gold went down roughly $34, $32, somewhere around there. I'm just going by memory, so I don't know the exact number. And you can see the stock market went up. And the good news is this confirmed that gold's in a bull market, because generally speaking, the miners they lead gold. If you look in 2008, the miners bottomed before the price of gold. And serving memory, now I could be wrong, but I haven't looked this up, but I remember the miners topping out around April of 2011, and then in June of 2011, gold topped out at around 1921. So the miners generally lead gold. And the Huey index was only down roughly 1.7 points, give or take, 0.9. It could be 1.77 or 7.3. But the Huey, not a lot of it. In my personal mining equity portfolio, which is basically my portfolio, that was positive on the day. I've never seen that. I'm going from memory. I was a bullion salesman, and I tracked the price of gold every day. Well, I ever since I've become a bullion salesman, but it was every minute of every day, every single minute of every day. I was in front of the screen because I was taking orders. I had to have spot price and everything. Any day, jobs numbers were positive. Economic data was positive. Whatnot. Gold would get smacked down. It would be a smack. Right down, and the gold price would be down 30, 40 like on Friday, but then the Huey would be down 10, 11, 12 points. It would not be marginally down and portfolios up, generally speaking, and sometimes it would go down 40 points. So positive economic data is bad news for gold and good news for the markets for the most part. Now, Avi wrote an article how GDP went up only 1.1. It was less than expected, and the markets went up and shouldn't have. But there were points last decade where it meant that the Fed was going to pause. The Fed was going to, not raise rates. So, and that's actually bullish for the markets if it's one-off. But if you get consistently bad economic data time and time again over a couple of years, the stock market is generally not going to be in a bull market. And that's the one thing I learned that most people don't understand. And the thing is, most people don't understand this because the data has been so manipulated and changed. And it doesn't really reflect what the average American's going through anymore. And so a lot of conspiracy theories have come out about them. I'm not talking about Avi in this. I'm just talking about market movements. And that's the one thing I noticed. But today was a perfect example. Strong jobs report. Market goes up. We could have that bad news is good news, where bad economic data could mean Fed pausing or lowering rates. I actually see strong economic data in the future being bad for the stock market. And the main reason I say that is if you check the FOMC meeting last week, the Fed said it's data dependent. I've heard this before. So really good news could mean, oh, all right, they're going to keep tightening and could lead sell-off. I'm not saying that's exactly how it's going to happen, but one thing in my opinion, though, is I was listening to an interview from Cycles Analyst, and I'm in agreement with them. I was sort of like in my channel here, I was talking about bad economic data going in recession, but I personally think the end of this post World War II bull market in stocks in 45 is over. It could make a new high. I would guess no, because I think they're manufacturing the jobs numbers. Fed's going to tighten credit, and a lot of things are going to be poor. Right now, what saved the stock market is people think the Fed is going to sniff out a rate cut. And so there could be one more, but the economy could also be so damaged that this time around the QE just doesn't work. It's like a drug addict. They take too many drugs, and eventually the high no longer comes. And that could happen. So, a lot of things could happen. A higher high, if I had to guess, I would say no, because these companies are not doing well. And I look at Google, and they talked about big tech last week having really good earnings. And in my opinion, if these earnings are so great and big tech so profitable, with the exception of Microsoft, how come Google isn't paying regular dividends? How come Facebook or Meta isn't paying regular dividends? These companies should be paying regular dividends. So I don't think they're in great financial shape, as they say. And you can see with all the layoffs, they're not in great financial shape. So anyway, just going back, that the main story of this lesson is stock market went up, economic data went up, but the gold market tanked. And as you can see, the economic data it has to be bad. Even if it's fake, the economic data. And then the second thing is miners generally lead. And the mining indexes were not really down much. And so this shows, based on the movement, that we're in a bull market. Now, could there be corrections? Yes, but I think they'll be brief. So anyway, that's all I have for today. I'm going to do some videos next week on just the segments of the markets, junior mining, mid-tier, maybe not in that order, royalty and streaming, because there's a lot of disinformation about royalty and streaming. So anyway, I hope you like this video. Hit that like button, subscribe if you haven't, and I'll see you next video.